So, what's the deal with rates? Clearly someone's interested in them. They don't call them uninteresting rates. What's the deal with that? So, so that is how I decided to open that. Yes. So there are a few ways to conceptualize interest rates. At their most fundamental, they are a percentage that is required to be paid on top of debt per year over some period of time. Mortgages have an interest rate that you pay each year on top of the loan when you enter them. Same with other loans and credit cards. And they're very fundamental to how the economy and financial system function. One way to conceptualize the significance of interest rates is as the cost of money over some period of time. If I were to forego $100 today, then how much would I need in 1 year to make it worth it to me? How much money is that time worth? If I were to say $105 in a year sounds good, well then that would be plus 5 on 100 that I made. So, that would end up being a 5% interest rate. How much is that time worth? In this case, 5%. In the broad economy, interest rates are the cost to borrow. So say an investor bought a $100 asset, putting in 50 of his own dollars and borrowing the other 50. So imagine this asset gains 10% in a year and is now worth $110 and gets sold. If the investor had borrowed that 50% at 2% interest rates, then he pays back $50 plus 2% of that, which is $1, $51 in total, and now has 110, pays back the 51, and has $59. On an investment that he put 50 of his own dollars into, that is an 18% return to him. But if interest rates were 7%, then he would have to pay back 50 and $3.50, 110 minus 53.5, he gets $56.50 as a return on the $50 of his own money he put in. He gets a 13% return. If money costs less to borrow, then a lot more projects and investments look a lot better than if money costs a lot to borrow. Investors buying debt are also sensitive to interest rates. If an investor bought US government debt in the form of treasury bonds, paying 2% per year, then that would be a lot less of a return than if government bonds were paying 10%. If an investor is going to take on more risk, then he demands more return. If a treasury bond pays 2%, for example, and an investor knows that he can always get 2% in that safe asset, then he would only want to invest in a risky asset like a stock if he expects that it will gain more than 2%. Why take on more risk without more reward? But by that same token, if now bonds are paying 10%, then a risky asset would also have to be paying more than 10% to make it worth it to take on that risk. So keep in mind as we go forward, rates determine how much it costs to borrow money and also how much return an investor needs to take on additional risk. This amount that treasury bonds pay as that base level of return expected is often referred to as the risk-free rate. This talking about credit riskiness might make you start thinking about credit scores and how that affects how much banks charge you when you borrow. Well, towns, world governments, businesses all have something similar, which are referred to as credit ratings. I won't go into how credit scores and credit ratings are derived now, but they exist for one fundamental premise. One borrower might be less risky to lend to, and one might be more risky to lend to, and how do you tell them apart? If a borrower appears more likely to default on their debt, maybe because they have very high debt, something governments are far too wise to ever do. Ha. Ha ha ha. Ha. Or maybe they have low income or have defaulted in the past, then just like going from a treasury bond to a stock requires a higher return for that risk, so will a riskier loan, hence a higher interest rate to compensate. Imagine two companies, Company A and Company B. Now, Company A has a really good history of paying all of its debts, it has really good finances, and then company B has defaulted multiple times and has really bad finances and an unstable amount of debt. Investors will require a higher rate to invest in company B's bonds because they have to factor in some likelihood that they won't get paid back. So, to compensate for that, B gets a higher interest rate from the market than company A does. And interest rates change over time. Since interest rates can change and the certainty and risk of lending for a short period of time versus a long period of time differ, loans and bonds of different lengths of time or time to maturity tend to have different rates, or as we would say, yield when referring to a specific debt security like a bond. Now imagine you go to invest in treasury bonds. You'll notice that there are all sorts of different ones. 1 month, 3 months, 6 month, 20-year, 10-year, all sorts of different maturities. Now you will also notice that they have different rates between them. I'll go more into how this all works later, but for now I just want to introduce the idea that different bonds with different lengths of time left in them, different maturities, have different yields. You may have heard the term yield curve before. Well, if you take different bonds, in this case different treasuries, with different maturities, and graph their different yields along an XY chart where the yield's on the Y, maturities on the X, then you start to see slopes and curves emerge, and this is what the yield curve is. And just bringing this back to everyday personal finance, you might notice this if you go to get a mortgage or a loan and you notice that a 15 versus a 20 versus a 30-year loan have different interest rates. Now there's a whole lot of math and a lot of tricky nuances to bonds that I will go into in later videos, but for right now I just want to give a general overview of how they work. So governments, towns, companies issue bonds. Let's say a bond is paying $5 in a 5% rate environment. So that bond will be priced at $100 when it goes out. That $5 at the end of the year is 5%. Let's say it's a 1-year bond, it pays you $105 at the end after you paid $100. So what were to happen if rates were to go up, say from 5 to 6%? Well, in this case, since it's a 1-year bond, and all we have to think about is that you get paid $105 at the end of a year, you have to work back from that and say, well, what amount would I put in now that 105 would be that plus 6%? And this isn't exact math, but it works out to be around $99, since 105 divided by 99 is pretty close to 1.06 or 6% return. And if rates were to go down by 1%, then it ends up being about $101, where 105 over 101 is about a 4% return. Now, there's more precise math that I'll introduce later in the video, but generally this is about rates go up 1%, a 1-year bond goes down 1%, rates go down 1%, a 1-year bond goes up 1%, all else equal. Now, in reality, there are a lot more dynamics to corporate bonds that have to do with the economic environment and their likelihood of default. But all else equal, this introduces the general concept of rates go up, bond prices come down, and rates go down, and bond prices go up. Now, I just want to review some terms and introduce some new ones that are applicable to bonds and really particularly important. The coupon is the amount a bond pays at each payment. The face value is the amount, not including the coupons, that's paid at maturity, like in our example of the $5 coupons and then pays back the $100 at the end. Yield is the annualized return, so over the span of a year, the investor is paid for owning the bond. The rating is the third-party riskiness score that's been given to them. Maturity is when the bond makes its final payment and then is retired. Duration has a couple different ways it's used. The Macaulay duration is probably the most straightforward one, which is if you average all of the payments and weight them by size, on average, what is the time it takes until all cash flows are paid? Now, modified duration doesn't quite sound like what one would expect duration to normally mean, but it's probably what you will hear the most when discussing bonds. It's the amount the bond's price changes when interest rates change. Specifically, if interest rates go up or down 1%, how much do we expect that the bond's price will change, either up or down, in response to that change in rates? Now, I've included the formula of how to derive the modified duration because it is really useful when analyzing a bond, and I'll be going into more detail in later videos, but one point I want to stress with this is that modified duration is based on how we expect bonds to behave. It's mathematically derived and isn't necessarily what will happen to the market price of the bond. That the term for is the empirical duration. Modified is just a mathematical expectation. The last thing I want to touch on in this video is inflation. Now, you might have heard about the Fed raising or lowering rates because of inflation. The Fed sets rate targets through the rates that it offers to banks. And it also does so by buying and selling bonds on the open market to change the supply and price in order to change rates. Say the Fed wants to lower rates. It will buy bonds, increasing their price, making them more scarce in the market, and as that price goes up, rates will go down. And if the Fed wants rates up, they will sell bonds, the price decreases, the supply increases, and rates go up. Now, this goes back to an earlier conceptualization that I noted. Because rates can loosely be thought of as the cost of money, if money costs less, rates are lower, then money is more available and less valuable, which leads to inflation of the currency. And if rates go up, then money's harder to get. It's more scarce. And that means less money in the economy, more valuable money, and inflation decreases. So I hope you enjoyed another riveting episode of Charts and Numbers. I hope you found this helpful, and if you're interested in seeing more of this, then do subscribe, as I'll be going deeper and deeper into the financial system and how this works until we get to the horrible realization that nobody really knows how it all works, and we're just hoping this keeps going. So, have a most splendid day.